Welcome back, guys. In today's video, we're gonna break down exactly how to start investing in the stock market for complete beginners.
By the end of this video, you'll know everything from opening your first investment account to buying your first stock.
We're also gonna have some important tips near the end of the video to help you make better investment choices, so stay tuned.
Yay! There are a few things that need to be in order before we get to the good stuff. Your financial health needs a quick checkup. Starting with any bad debt, let's make sure there is none of it.
We made a video on the quickest ways to get rid of debt. You can check it out up here if you need a few pointers.
Next, make sure you have an emergency fund. 6 months of your expenses is usually recommended for those unexpected twists that life throws at you.
So we recommend keeping your emergency fund in a high interest savings account. This way, you can generate a little bit of interest when your money's parked at the bank.
The last thing we need to check up on is cash flow, which is basically just your income minus your expenses. Now, if you're using a typical budgeting method, you'll probably want to put about 20% aside for savings.
So if your emergency fund is all set, then this 20% is going to be the money that you use to invest. So we caution against investing money if you have debt or other expenses that could end up costing you if you missed a payment.
Moving on, we have to explain a little bit about the different types of investing accounts. The most important ones to focus on when you're just getting started are the tax-advantaged investing accounts.
These are accounts like Roth IRAs, which let you invest $6,000 a year, and your earnings generally don't count towards your income tax.
In Canada, the comparable account is the tax-free savings account, where you can also contribute $6,000 a year, and there are no taxes on earnings.
So others include retirement accounts such as your 401ks or RRSPs in Canada, which defer taxes until you begin to withdraw your investments in retirement.
The idea behind retirement accounts is that you'll be in a lower tax bracket when you're retired compared to when you're working.
So often employers may offer a matching program where they're going to contribute a portion of what you invest into these accounts monthly.
If this option is available to you, we 100% recommend taking advantage of it. Anytime you can get some free money, you gotta take it.
So look into these types of investment accounts first because they can save you money in taxes.
Now it's time to choose what brokerage you'll use to buy your stocks. A brokerage is just a company that acts as a middleman that connects buyers and sellers in the stock market.
There are a few different types of options, starting with full service brokers. These are your big banks and your private investment firms.
Here you'll get a full suite of options for investing, as well as financial advisors that will help you with planning and give you some portfolio advice.
Of course, all this comes at a premium, usually anywhere from 1 to 3% in fees. Although this could be useful for beginners that need the help, these fees do eat away at your returns.
As competition grows between brokers, investors are moving to lower fee competitors. This brings us to discount brokers.
So in 2014, Robinhood crashed onto the scene with zero commission trades and a very user-friendly mobile app.
Since then, lots of brokers have followed their lead with zero fee trades and ultra low expense ratios on passive investments like index funds.
So with many young people taking an interest in investing, these companies have started offering cheaper options for investing at a fraction of what these full-service brokers are charging.
Some of the most popular brokerages are Vanguard, Charles Schwab, or Fidelity. If you are in Canada, Wealthsimple and Questrade are pretty good options as well.
So these brokers all have websites and apps that offer self-directed investing accounts with low fees so that you can manage your own portfolios.
Now that we've given you guys some options for brokerages, let's walk through how to open an account. While every brokerage is gonna be a little bit different, generally, you're gonna need the following information. Max?
So personal information like your email address, not that junk email.
No junk.
At tatertotfreak@hotmail.com.
Your name, birth date, home address, and your social security number to start with.
They will also ask you some odd questions about insider trading. If you don't understand these questions, they probably don't apply to you, so don't even worry about them.
Next, they'll require information about your identity, your employment and income, and of course, what sort of account you're looking to open.
Once you've chosen the type of account, you need to agree to the legal terms and promise to pay your taxes, unlike Al Capone. This should be pretty much everything you need to create the actual account, except for one thing. Max, what's that one thing?
So once you have the account ready to go, you gotta fund it. This means setting up your bank information so you can transfer money into your investing account. Once it's funded, you can finally start trading stocks.
Before you buy your first stock, let's break down what types of stocks there are. First up is individual stocks, which are just small pieces or shares of a publicly traded company.
So an example of an individual stock would be like Tesla or Amazon offering shares of their company to the public in exchange for money. If the company is successful, generally your shares increase in value and they can be sold for a profit.
The same can be said for a company that isn't successful. This is where your shares could actually lose value.
You said tech stocks were bulletproof!
This is why some investors prefer dividend-paying stocks. Max, what is a dividend?
A dividend is when a company rewards its shareholders with a portion of its earnings. Companies like McDonald's, Coke, and Colgate have all paid dividends for the last 45 years straight.
Next, we have investment funds, which are broken down into two types: mutual funds and exchange-traded funds, or ETFs for short.
So the strategy behind these funds is to offer exposure to many different investments under one umbrella.
The benefit of having this diversification is that if one company does poorly, it won't erode all of your profits, and you'll probably be okay.
In the case of a mutual fund, a fund manager actively balances the portfolio in an attempt to obtain maximal gains.
Did you say Max?
I said Max.
You did say Max. Of course, with all this managing going on, the fees on these funds are usually quite high, so be wary of that.
So ETFs also offer exposure to many different investments, but the investments inside of them aren't actively managed, and they usually track an index or a sector.
An example of an ETF that follows an index is the Vanguard 500, which follows the top 500 companies on the S&P 500 index. In the last 10 years, it has compounded an annual return of 15.32%.
The great thing about ETF index funds is that they're passive investments with really low fees. So you can literally just invest your money and watch it grow.
Not financial advice, of course.
There are other types of investments like bonds or REITs. A bond is basically just a loan to a lender with an agreed upon rate of return over a specific period of time.
The pros of bonds is that your return is guaranteed and you can't lose your money. The cons are that your money is locked up for a term and your returns are generally lower than other investments.
REITs, on the other hand, offer exposure to real estate investments without having to personally own real estate yourself. And they usually provide some pretty good dividend payouts.
As we promised, here are a few tips to remember before you get started. Always check your emotions at the door. If you're investing long-term, don't worry about short-term fluctuations.
Next, invest with your risk tolerance. This means you shouldn't expose yourself to higher risk investments if you aren't comfortable with the possibility of losing it all.
Also, pick companies, not stocks. It's always good practice to understand the company you're investing in. You want to know how the company operates, performs, and what its future goals are.
Another important tip is that you shouldn't try to time the market. The stock market is very unpredictable, and a lot of the times it's driven by investors' emotions, which can hurt them.
So we recommend dollar cost averaging in. It simply means making regular contributions to your investment regardless of what the market is doing.
Always remember, it's time in the market,
not timing the market. So now that you have a basic understanding of how to start investing and a little bit of knowledge on stocks and the stock market, now might be the right time to begin your investment journey.
If you need more help choosing exactly what to invest in, you can check out our video on the best stock market research websites.
So if any of this information has helped you out, or if you're still a little bit confused about some of it, leave us a comment below and we'll try to get back to you as soon as we can.
That's it for today. We hope to catch you guys on the next video. With that said, I am Mike, that is Max,
and we are Mike and Max.